to this computer. All right, so I'm recording now. Basically, we're talking about performance-based options, whether it's performance or market-based. And so we're looking at the performance-based option. Depends initially on whether it is probable that the performance target will be met. Again, because really this is a contingent issue, isn't it? So if we're not going to have to pay this, okay, which would be an expense to us or an obligation, right? Then are we going to have to book anything? Right? Ultimately, on whether the performance target is actually met. All right, so there's two components of that. So here's an example. All right, as of January 1st, 2016, Universal Communications grants an option that permits the key executives to acquire 10 million of the company's $1 par common stock, right, at the fair value option of $8. All right, so in our previous calculations, their compensation would be $80 million. Okay. However, but because it is not probable, right, and again, if you remember the rules going back to contingent liabilities, something that's probable only has to be more than 50%. Right? That's something. So if it's not probable, that's under 50%. And therefore, we would not make any kind of journal entry. However, after 3 years, okay, things have changed, all right, and it is estimated that it's probable, okay, that sales will increase by the 10% that's required. All right? And so after 3 years have passed, okay, we're going to record, again, they're getting something of value for the whole 80 million if it happens, right? But because they're only 3 of the 4 years in, okay, 3/4, 75%, we're going to multiply that 80 times 75%, and that's what we're going to do. We're going to record that as an expense for the current period. Again, why? Well, because it didn't become probable until this year. And so this still does accomplish the matching principle because this is an estimate, right? You guys remember the rules for estimates? Estimates, you do not have to do retroactive restatement. It's just prospective, all right? So at this point, because it's probable, all right, we're going to record the full $60 million, right, in 2008. We do not have to go backwards. Then finally, all right, in 2019, all right, when we actually do, because at the end of this year, we've met that criteria, and so we would expense just that last year or the remainder portion. That's what they're showing us down here. So let me show you. Down here, they're showing us the calculation that, hey, we already recorded the, what is that? How's that? You like that? Okay. I hit the wrong button, but I like it. All right. But yeah, we already recorded this last year. All right. And so we're taking the full amount and just taking the portion, right, or the $20 million this year. So let me go back to my normal pen. We're good? Plans with market conditions. If the market target is based on the changes in the market rather than the performance, compensation is recorded as if there was no target. Therefore, we're just going to spread it evenly. All right, compensation expense is recognized regardless of when the market condition has been met. Changing gears. All right, employee share purchase plans. All right, what we've covered so far, as I said, we're basically top management, right? So your CEOs, CFOs, VPs and whatnot, right? This employee share purchase plan is for everybody else, right? It permits all employees to buy shares directly from their company at favorable terms. Again, the intent, right, is to encourage employee ownership in the company shares, which then causes loyalty, because if you're working for the company and the harder you work, the better they do, right? The more that's going to benefit you. And so benefits to employees, right? Again, you allow employees to buy shares at a discount, all right, without brokerage fees. In order to meet the criteria for these sort of plans, all right, it has to be or for this to, so that we don't have to record it as an expense. Right? That's what they're saying, the non-compensatory. Okay? All employees, right, are allowed to participate. Employees have no longer than 1 month after the price is fixed to decide whether to participate. And the discount is no greater than 5%. So if these criteria are met, okay, right, we don't have to record it as an expense. Right? It's just a benefit that we're giving to our employees, and we do not have to record compensation expense. If these criteria for the plan being non-compensatory are not met, then we have to record it as an expense. So an employee buys the shares under the plan at a 15% discount to the current market. Is that meet the criteria? And yes, I hear the whole class go, no, all right, because it's got to be less than 5%, right? And this is 15%. So in that case, all right, we're going to have to record the compensation expense. Right? So they get the common stock, all right, they're purchasing it. They take 15% off that, all right, and we have to record that as an expense. If this was 4, then we would not. Okay, so if it was 4% instead of 15%, then that would meet the non-compensatory requirements, and therefore we just have cash, all right, 1,000, common stock 1,000. Easy enough? I think so. Okay. So the decision maker's perspective, analysis should be aware of the possibility of earnings management as a way to increase managers' compensation. All right. If a manager's personal compensation includes company stock options, and other compensation based on the value of the firm's stock, it is not hard to imagine the increased desire to ensure that the market expectations are met and that reported earnings have a positive effect on stock prices. And so what they're really getting at here is that, one of the benefits, all right, of stock options and grants and things like that is that, hey, it makes the employees work harder, right, to accomplish those things, right? But then there's a downside because if they're not going to meet those targets, they may do fraudulent transactions in order to get their bonuses, if you want to think of it that way. All right, so you want it to be an encouragement, but you don't want them. You don't want your employees to do things unscrupulously, all right, in order to meet their targets. And believe it or not, this is what was happening with Enron, WorldCom. Most of the failures, management were trying to manipulate the numbers so that they could hit their targets, right, and therefore hit their bonuses. One way managers might manipulate numbers is to lowball the data, all right, that go into the option pricing models. So that, and if you remember when we talked about budgets, we talked about, what is it called? Budgetary slack, right? Where, we're like, oh, I don't know if we're going to hit that number, but in reality that's an easy target to hit. Right? And so that's what they're kind of addressing here. And then there's just the flat out, not embezzlement, because embezzlement's taking things where fraud is, reporting inaccurate numbers. Changing gears. All right, as I said, this chapter really consists of two completely unrelated stuff. Well, I mean, not completely unrelated, but for the most part, we are completely changing gears. All right, and we're going to be talking about earnings per share. So hopefully you guys remember, because from Accounting 202, when you did that comprehensive problem, if you didn't put the earnings per share at the bottom, you lost points. All right. Because communication of earnings per share is required under generally accepted accounting principles. Right? And so hopefully you guys remember earnings per share. Okay. I told you this is the one thing that you need to memorize, and I'm sure it's on the next slide. All right. but you want to take net income, subtract your preferred stock dividends, and divide that by the number of shares outstanding for common stock. If you don't know that equation, right, if there's any financial ratio that you're thinking is worth the time in your brain, right, this is the one, all right? It's the most widely used financial ratio, and it does communicate a lot of quality information. Right? Obviously, what if you have one share, what did your company earn for you, you being the common shareholder, right, the true owner, because the preferred stockholders aren't really owners, right, because they don't have a say in what happens in the business. And so the true owners, the common shareholders, finding out what is left for them. So yeah, earnings per share, earnings available to the common shareholders. Okay, again, that's your net income. Subtract preferred stock dividends. And it doesn't matter, okay, just so you know, it doesn't matter if this is cumulative or not, if it's paid or not, the preferred stock dividends, right? If there's dividends in arrears, it's only the current year's dividends. Right? And so, and then we're going to divide that by the weighted average number of common shares outstanding. All right. So this is a little step further than the previous equation that you've learned, right? Where we're just going to have to do the weighted average, right? Because even though most of our scenarios, common stock does not change, right? There is the possibility of those changes. So we'll see, we'll actually work the denominator side of things too. So the calculation of earnings per share becomes more demanding when the number of shares has changed during the reporting period, because that's going to impact, again, the weighted average, right? Earnings available to common shareholders are diminished by dividends to preferred shareholders, and we attempt to take into account impending effect of potential shares, all right? And so this, truthfully, is the only thing that is tied to the beginning of this chapter, all right, are those shares, all right, those options that can be exercised, all right? And so, yeah, we'll deal with that in a minute. So our first illustration, Soran Financial Corporation reported net income of $154 million in 2006. They're 16, I should say. Their tax rate is 40%. All right. Its capital structure consists of, at the beginning of the year, all right, 60 million shares were outstanding. However, well, actually not however, we're going to change that. All right. So basic earnings per share, okay, takes the net income divided by number of shares. All right, $2.54. What does this mean? Okay. It means that if you had a share of common stock, right, you would have earned $2.57. Does that mean you received $2.57? The answer is no, okay? Because what you would have received would have been dividends per share. Okay? And again, with dividends per share, we're still using the same shares outstanding. Okay. So to add to this calculation, all right, we're going to have to give a weighted average, all right? And so the textbook runs this through. I have a different way that I do it than the textbook does, and I will show you that, okay? But for the most part, from January to March 1st, okay? That, by the way, is 2 months, right? So this is 2 over 12, okay? Then we add, all right, 12 million shares, okay? And so really what we have is we have 72, right? All right. And so the way that I do this, okay, at the bottom, okay, is, this didn't change, okay? But to get a weighted average, okay, what we're really saying, and I guess you could do it this way too, all right? But the way that I do this, all right, I just take the 60 million. Okay, we multiply that times the number of months that we had 60 million, or 2 over 12. Right? And so we have 60,000 times 2 divided by 12. Right? And that comes out to be 10. Right? And we then had 72, right, shares times 10 over 12. So 72 times 10 divided by 12. Okay. All right, gives us 60. Add those together, gives us a 70. You can do it their way, you can do it my way. All right. Whatever way makes more sense to you guys. All right. And so what we've just done is we've taken a weighted average. All right. Stock dividends and stock splits, okay, they have an impact on the number of shares that you have. All right. So the distribution of additional shares, all right, to existing shareholders. All right. The change in the nature of shares is reflected, all right, in a calculation of earnings per share by increasing the number of shares. Okay. And so the increase in shares from selling new shares, okay, we're just going to take the weighted average of those things, all right. Shareholders' interest in their company's earnings is going to be diluted, right? Because the denominator has gotten bigger, right? Whereas with stock dividend, all right, really we're not giving them anything, right? We're giving them more shares, but then we're decreasing the value of those shares, right? And so the increase in the number of shares without affecting the firm's assets, okay, the larger the number of less valuable shares, right? And so really we're not giving anything. We're just, the pie stayed the same. It's just we have more slices now. Okay. But how that impacts, all right, your weighted average is with the stock dividends, we're going to treat everything above as if it took that stock dividend or stock split. And so here we go. All right. And so let me just tab just to see if I have room to write. Okay. And so again, the way that I would have done it, all right, is that you had your 60,000 shares. We had that for 2 months. All right. So we multiply that times 2 over 12. Okay. Then we added 12, right? Okay. And so that gave us that, 72, okay, all right. But that was from March, okay, March until June, okay. And so if you think about that, that's January, or I'm sorry, all of March, April, May, June. So do we include June or not? Should we include June or should we exclude June? Well, because this is on the 17th or after the 15th, if it's the 15th or beyond, you include it, all right? If it's less, then you would, whatever. So if it was like the 14th, you would exclude it, all right? So we're going to count that, all right? So we had this, all right, at 4 over 12, right? But then we had this stock dividend, right? And so if we took the 72, multiplied that times 0.1, I don't know why I even did that. All right, we have a 7.2 increase, right? And so add that to 72. And so we have 79, right? 2. Does that make sense? Right. However, right, this was the dividend, okay, that we increased it by. Okay. What we need to do is we need to adjust, okay, these other numbers up here. And so what we're going to do is we're going to multiply that times 1 plus the dividend, right, or 1.1. Okay. And we're going to do this one by 1.1. And then we're just going to multiply this, all right, as 6 over 12. Right? So July, August, September, October, November, December. And so 60 times 2 divided by 12 times 1.1 gives us 11. 72 times 4 divided by 12 times 1.1 gives us 26.4. And then 79.2 times 6 divided by, that's a 12. I don't know what that is. All right. Gives us 39.6. Add all these up. And we come up with a weighted average of 77. Okay. Are we good? All right. You can do it my way, or you can do it their way. All right. Isn't that beautiful? Okay. Let me erase, all right, my other stuff. I think I can do that. Eraser. So you can read that better. Okay. And they come up with the same thing. So again, all right, however you want to approach that, knock yourself out. Reacquired shares. The weighted average number of shares is reduced if the shares are reacquired during the period. And so the number of reacquired shares is a time weighted for the fraction of the year that they were not outstanding prior to being subtracted from the number of shares outstanding. When a stock distribution occurs during the reporting period, any sales or purchase of that purchase of shares that occur before but not after the distribution are increased by the distribution. Man, that's confusing. All right. So here, all right, is another scenario. Okay, and so basically, all right, how you would go about doing this. All right, you take the, and really all we're doing is we're looking. Ooh, that's eraser. We're just looking at the time periods. All right. As such, if you're going to do it my way, that's what I'm saying. All right. And so just to write this out again, I guess. All right. We had the 60, all right, million. Okay. We multiplied that, all right, times the dividend of 1.1, all right, and the number of periods, so January and February, or 2 over 12. I don't remember what that was. You guys can tell me maybe. All right. Then we had March to June, right? That was the 4 months, right? We had sold 12, so that brought up to 72. And we multiply that 4 over 12, right, times 1.1. But that's when we gave the 7.2, bringing us up to what is it? 79.2. Okay. And this one, however, we kept from July, August, September, October, right? Because if you remember, we didn't count June, right? And so that is going to be times 4 over 12. Right? We don't have to worry about the dividend, because that's already included in here. But now what we got to do is we got to say, hey, on October 1st, we're going to subtract 8 million. Okay. October 1st, and that brings us down to 71 million 2, right? And so we have October, November, December, right, 3 over 12. Did I do my math right? Let's see. No, I don't think it did. All right, so we don't count June. So June, July, August, September. All right, so yeah, this should be a 3. And so hopefully, all right, first of all, you learn from my mistakes, all right, because I even crossed that out, but I actually counted October, but it's October 1st. It doesn't count, right? It's just the beginning of October. And so again, we could extend these all through, and I don't remember what that first one was, 60 times 2 divided by 12 times 1.1. That came out to be 11. The 72 times 4 divided by 12 times 1.1 gave us the 26.4. And then we have the 79.2 times 3 divided by 12 gives us 19, oh, that's 19, 8. Okay. And then 71.2 times 3 divided by 12 gives us 17.8. Okay. And so we just add all these up. 19.8 plus 26.4 plus 11. Okay. We get the weighted average now of 75. Questions about that? Now, I don't know if you probably didn't see, all right, what I did. No duh. All right, but when I was checking my times, my months, okay, take note that this and this and this and this have to be 12, right? Because it's 12 over 12, 1 year, all right? And so that's how I caught that error that I had made before I did my math. So let me erase all of that for you. Okay. And by the way, this is the last time I'm going to do that. I think we're done, by the way, but I'll just highlight it. They're under their method. You guys hanging in there?
Yeah.
All right. Or have you gone to the kitchen to get some more food? All right. So, again, you can do it my way. You can do it their way. I learned my way, and so that's why I stick with it. Their way comes out with the same number. Okay, I just like my method, probably because that's what I know. All right, but you learn it however is beneficial to yourself. Okay. Earnings available for stock or common stockholders. When a senior class of shareholders, like preferred, all right, is entitled to a specific allocation of earnings, like preferred dividends, these amounts need to be subtracted from your net income. All right. And so here we have the same scenario. Okay, so what we've done in this case, we've calculated the weighted average. All right, so I'm assuming that this was the same numbers that we've been using. All right, yeah. All right. But the thing that's changing here is that we're going to have some preferred stock. All right. And so on January 1st, we had preferred stock outstanding. We had 5 million shares of 8% $10 par. Okay. And so you can do this multiple ways. All right. But basically, to find out what the dividends that a preferred shareholder is supposed to get, all right, this is 8% of $10. Okay. So you're going to do, 8%, right, times $10. And then you're going to multiply that times the number of shares, 5 million. And so this, because really it's saying, hey, that we're going to get 8% of par, okay? per share, and because there's 5 million shares, we end up, right? Oh, I could have just done that, Okay, so we're going to subtract that $4. Now, I want to point out, because I don't want you guys to get lost, this is still basic earnings per share. Right? It's just we're adding components to it. I mean, this again was the weighted average, all right? And then this is really the new component that we're discussing now, which is whether these shares have been declared, paid, it really doesn't matter, right? This is what they're supposed to get, right? They're 8% times $10. That moves us then into a complex capital structure, all right? Potential common shares, all right? So when we're talking about basic, all right, it does include preferred stock, right? But when we're talking about a complex capital structure, what we're really addressing, all right, is the potential common shares, okay, from other things, right? Securities that are not common stock but might become common stock through their exercise or conversion. And so what we talked about earlier, all right, were those options, right? So if you understand, if somebody exercises those options, that's going to increase the denominator, right? Because those were the number of shares outstanding. And so when that's the case, right, we have to then communicate the diluted earnings per share, or the potential diluted earnings per share. A complex capital structure, all right, arises when any potential common shares are outstanding. Okay, examples could be convertible bonds, because if you remember, all right, bonds that could convert into common shareholder or to common stock. Convertible preferred stock, again, converting into common stock. Stock options that we talked about earlier, and contingently issuable securities, all right, which is what we talked about earlier. So if the market gets to this level, blah, blah, blah. A firm with a capital complex structure reports 2 earnings per share, potentially. We're going to record the basic, which we just got done talking, and then the possibly diluted earnings per share. Because if they're non-dilutive, because there is some ways that they don't dilute it, they actually make them a better earnings per share, then we're not going to disclose that, right? Again, we're applying the conservative principle, or the worst case scenario. And so options, rights, and warrants give this the holder the right to exercise their option, right, to purchase common stock at a specific exercise price. Right? So this is what we covered earlier. Dilution results from the exercise, should be reflected in the. If it dilutes earnings per share, you need to disclose that. To include the dilutive effect of securities means to calculate earnings per share as if, okay, and that's important, as if the potential increase in shares has already occurred. All right, and, so when we're doing our weighted average, we're not going to prorate this unless, let me just say this, unless we issued those options partially through the year. But if they were issued or offered prior to the current period, we treat it as if they were exercised at January 1st, or they were outstanding for the whole period. And yeah, options or rights were exercised at the beginning of the reporting period, or when the options were issued, if that was later. Cash proceeds from selling the new shares at the exercise price are used to buy back as many shares as possible at the share's average market price. That's important. So here we got our little scenario, all right? Same stuff, all right? Wasn't this 75 initially? Okay. I think this was, the last one we ended off, that was 75 million shares outstanding. If I remember correctly, that's what it And we had our preferred stock calculation, the dividends. Okay. Incentive stock options. Executive stock options granted in 2011. And again, this is 2016, so it was in a previous year. Exercisable after 2015 for 15 million shares, all right, at an exercise price of $20, all right. And so what we're going to basically do is we're going to say, hey, because if you remember, all right, with these options, they still have to pay us for these things, right? And so what we're going to do is we're going to say, hey, they're going to pay us. Let me calculate this: 15 million shares times $20. They're going to pay us $300 million, all right, for those shares. Well, we get that cash, right? And so what are we going to do with that cash? We are going to theoretically, right, we're going to buy back shares on the open market. Okay. And so, I get this was the basic. Okay, my bad. I'm like, what? Why are they showing us that? All right, diluted. All right, okay. We're going to increase, all right, the number of shares in the denominator. Okay, and so if you remember, we had the 15 million times the 20. This gave us $300 million. Okay, and I didn't see where it read that. Oh, here it is. Okay, our average price per share, okay, in 2016 was 25. So we took that 3 million and we went out, okay, and bought. So if we took the 3 million and we divided it by 25, okay, that's where we come up with the 12. Right. Okay, so we had that 3 million. All right, we're dividing it, all right, by $25. That was the average market price. We purchase these things off the open market, like treasury stock, and that's why it's called the treasury stock method. We end up with a 12. Okay. And so we increase by the difference. So we had, we increased it by 15. We bought back 12, right? And so that's where the 3 comes in. So 75 plus the 3 gives us 78. Right. Now, take note, because in this is stock options and things like that are the only ones that don't impact the numerator. It only impacts the denominator. And we don't have to do any kind of weight on that, right? Because we make the assumption that it was those options were purchased at the beginning of the period, even though they weren't. This is all theoretical. Right? Convertible securities does have an impact on the numerators. Right? Securities that can be converted in or exchanged for shares and stock at the option of the stockholder, right, or the holder of that security. For this reason, securities are potentially dilutive. Okay? The potential dilutive effect of convertible securities is reflected in the diluted earnings per share calculations by assuming that they were converted. Okay, and again, as long as it wasn't a partial, like we didn't sell convertible bonds halfway through the year. Okay, if they were sold in a previous year, we treat it as if they were converted as of the beginning of, as the beginning of the period. The effect on earnings per share, all right, when such securities are converted, okay, is going to impact both the denominator and the numerator. Because really the only two kind of convertibles that we discussed were convertible preferred stock. And so if the preferred shareholders convert, do we have to pay them dividends? We do not, all right? Because if we make the assumption that they converted at the January 1st, that would mean we would not have to pay them those dividends. Right? However, if they converted to the number of shares of stock, common stock, the denominator is going to increase, right? The other type of convertible was bonds, right? convertible bonds. Convertible bonds, right, the cost of financing using debt is interest expense. And so interest expense is a tax deductible expense. That's going to have an impact on net income, right? So if they converted as of the beginning of the year, all right, we're not going to have to pay them interest. Okay? Therefore, our net income is going to increase, before tax. Right? So there's a tax ramification. So here's the scenario. All right, so we had the same number of shares outstanding. The average price is the same. Okay. I think so we're dropping the old, oh no, we're not. So we're still got that incentive stock option, okay. But we're adding one more thing. Whew. All right, we have convertible bonds. All right, we have 10% $1 million or 3 million face amount issued in 2015, convertible into 12 million shares. All right, so hopefully you realize that this is on the denominator. Okay, all right. So that's going to increase our denominator. Okay. However, the tax savings, right, or I should say not the tax, but the interest that we're saving on that, what is that, 10% of 3 million, right? So $3 million. $30 million, $30 million. Right? We're going to save that. Okay. And so we're adding the conversion of the bonds. Okay. But, all right, we're saving that $30 million in expenses, therefore increasing net income by 30. All right. However, because that's pre-tax, we have to subtract our tax. Okay, so 40 times the 30. Okay. And so, I don't know, they didn't give us that number, did they? So 30 times 4, so 12, so so this ends up being 18. That we're going to add. So 18 plus 4 plus 154. No, that does not come out. Oh, subtract, I added. 150 plus 18. Yeah, that's that number. Easy enough? Okay. Convertible preferred stock. Again, we're going to make the assumption that it was converted at the beginning of the period. The effect on the earnings per share calculation, right? We're going to increase. Oh, my internet is unstable. All right, we're going to increase the denominator by the number that have been converted. Okay, and the preferred dividends are going to either go away or be reduced. So we're going to say that these are convertible, right, to 3 million shares. So we're going to increase our denominator, and following their example, we're just going to add back, right, the dividends. So instead of subtracting them here, we're just going to add those back. And take note, all right, and I didn't highlight this in the previous slides, okay, all of these numbers were smaller, okay, than our basic, which means we've diluted, all right, our earnings per share. And so we would need to disclose both of those numbers, the $2 basic and $1.85 diluted earnings per share. Anti-dilutive, right, would only happen, this doesn't happen very often, okay, if the effect of the conversion or exercise of potential common shares would increase rather than decrease, right? If that's the case, we're just going to completely ignore that, right? The one that wasn't dilutive, right? And so examples, options, warrants, and rights, okay? When the buyback or the average market price is higher than the exercise price, okay, The number of shares assumed to be repurchased is fewer than the number of shares assumed to be sold. All right. So when we're doing the treasury stock method, we're basically saying, hey, the average price was less. Okay. So if somebody did exercise those things, we have more money. So instead of the 300,000, right, we'd have a number that would have been higher than the average market price, and therefore they would not be diluted. Nobody would be in their right mind if you could have buy the stock for $26. That was the market price, and your option was 28. Well, that would be foolish, right? You wouldn't convert your shares, right? You would just wait it out, or you would have bought them at 26 if you really wanted that ownership, right? And so, yeah, they basically run through different scenarios where those would be anti-dilutive. So here's an example. Warrants granted in 2015, exercisable for 4 million shares of common stock, and an exercise price of, $32. We're comparing that to the 26, wasn't it? Where's the average? Or wasn't it 25? I can't remember. All right. Calculation. All right. Both basic and dilutive are unaffected, right, by these warrants, because the effect of exercising the warrants would be anti-dilutive. Because this is higher. The $32 is higher than the average market price, which I don't see it here any longer, but that's why. Convertible securities. Right. Difficult to determine whether the effect of conversion of convertible securities would be dilutive or anti-dilutive, because the assumed conversion affects both the numerator and the denominator, right? And so you basically have to go through the calculations. So if the incremental effect is greater than basically earnings per share, then it's anti-dilutive. If it's less than, then it's dilutive. Okay. And so, they're showing the conversion of the bonds. Okay. This, right, is, so they're just showing you the cumulative effect, or this is smaller than that, it's diluted. Cool. In order of entry to multiple convertible securities. All right, so yeah, the deal is what if you have all of these things? What should be converted first, right? So a convertible security might seem to be dilutive when looked at individually, but may be anti-dilutive when combined with other convertible securities. Earnings per share incremental shares is used to determine the sequence of issuing security effects. The securities are included in reverse order, beginning with the lowest incremental effect, that is the most dilutive, followed by the next dilutive. So you basically have to look at each one individually, all right, and then pick the one that's most dilutive, apply that, then the next dilutive, and so on and so on. Components of the proceeds in treasury stock method, all right? The amount, if any, received from the hypothetical exercise of options or vesting of restricted stock, usually zero. All right, the total compensation from the award that's not yet expensed. So an example of if the options are fully vested, all the compensation would have been expensed. Right? Because remember, if we have, that compensation expense is going to impact our net income, right? So that's what we're looking at. If the options are fully vested, all compensation would have been expensed, and this second component of the proceeds would be zero. If half invested, then half the compensation would have been expensed, and the remaining half would be added to the proceeds. The excess tax benefit. If the options were non-qualified options, the corporation receives a tax deduction at exercise equal to the difference between the stock market value and the exercise price. because of the reduction or of net income because of compensation expense. The difference times the tax rate is the excess tax benefit. If the options were incentive stock options, no tax benefit is provided. So additional issues, all right. Components of the proceeds of the treasury stock, all right. Sullivan Financial reported net income of 154 million in 2016. Its tax rate is 40%. Its capital structure includes executive stock option grants in 2011, exercisable in after 2015, 15 million common 50 million common shares at an exercisable price, right, of $20. The average market price of the common shares during 2016 was 25, right? So that's less. And so we're going to look at, first component, right? Price at a hypothetical exercise. We subtract the exercise price, or the $20. This is a tax deduction at hypothetical exercise. We subtract the fair value at the grant, right? The amount expensed over the vesting period gives us $1 million excess tax deduction per option. Multiply that times the number of options, gives us 15 million excess tax deduction times the tax rate, right? It gives us the tax benefit of $6 million. Restricted stock awards and unit RSUs in earnings per share. Okay. We're replacing stock options as a share-based compensation choice plan. Represents potential. So in this case, if you remember, no cash, right, changed hands. All right, this was just given to them as a thank you. How do you do? All right. So there is no cash, right? But that is all. This is going to increase, right, the denominators when they vested or when they get them. However, we spread that cost of the compensation over the previous years. The shares are added to the denominator and then reduced by the number of shares that can be bought back with the proceeds at an average market price of the company stock during the year. The first component of the proceeds usually is absent because the employees do not pay to acquire their shares. Unvested restricted stock award shares and RSU shares are included in the hypothetical earnings per share calculation. Fully vested shares are distributed and thus outstanding. The second component, proceeds from the earnings per share calculation, include the total compensation, all right? So if they've been reducing it, we spread this compensation over the 4 periods, right? And so for the this last period, they have that reduction in their net income. So that's what they're addressing. So under its restricted stock unit plan, universal communication grants representing $5 million, $1 par common shares, certain key executives. The shares are subject to forfeiture if employment is terminated within the 4 years. Shares have a current market price of 12. Okay. So there is no adjustment for the dilutive, right? Because they're not giving us any money, right? In 2016, all right, we had the 60 million subtract the 15 million because we're amortizing that over the 4 years, right? And so, the assumed purchase of treasury stock, 45 million, divided by the average market price is 3.75. All right. At the end of 2017, all right, we reduced that, okay, because of 2 years of the compensation expense. Brings it down to, dilutive would be the effect, right, is 2.5 million shares increase or subtracted from, I should say, not increase, the denominator. Contingently issuable shares, right, contingent on the occurrence of some future circumstances. So if you remember, it was either market-based or performance-based. Contingent shares are issuable to shareholders of an acquired company, certain key executives, or others in the event of certain level of performance is achieved. All right, there's a contingent performance, maybe a desired level of income, targeted stock price, or some other measurable unit. Considered to be outstanding in the computation of diluted earnings per share if the target performance level already is being met. All right, so if you remember, there was, I think, the example of an increase of sales by 10%. Right? If that has already happened, right, then we're going to include these. So if shares will be issued at the future date, if a certain level of income is achieved, and that level of income or more was already reported this year, those additional shares are added to the denominator and nothing's going to impact your numerator. So here, assume 3 million additional shares will become issuable to certain execs, all right, in the following year, next year. If net income that year is 150 million or more, okay, assume that the issuance of contingent, so it's happened already, right? And so we're just going to increase the denominator, which causes, your earnings per share to be diluted. Okay. Yeah, if we don't exceed, all right, so, our net income, okay, all right, reported net income, all right, of this amount here, okay, did not meet the 160. Therefore, the contingency is just be ignored. Disclosing this information, all right. Here's an example of Beanie Manufacturing of Muncie, Indiana. Anybody hear of that company? All right, so yeah, they're just disclosing, what is it? Acquisitions. Okay, in this case, what we're doing is we're buying another subsidiary and we're giving more shares. Okay. So what's that going to do to the denominator? It's going to increase that. What's it do to your total earnings per share? It's going to decrease. Hopefully, though, with the purchase of that new facility, that's going to ultimately increase our numerator through net income. So here's a summary. Is dilutive effect reflected in the calculation of earnings per share? Yes, this is pretty stupid. Yeah, okay, all these, if they're dilutive, all right, then we have to disclose that in the calculation. That's basically everything that we've been talking about this whole semester, or whole chapter, so I don't know why this is such an important slide for you guys. Here, I guess, is how it's going to impact the numerator or the denominator or both. You can read those. Actual conversions, so diluted earnings per share of convertible bonds converted during the year would be precisely the same, all right? And the reason being is because we make that assumption, all right, that they did convert as of January 1st. So their actual conversion isn't really going to impact the basic earnings, or I should say the diluted earnings per share calculation anyway. Yeah, and they're just going ahead and proving that. Right. Whatever. They come out to be the same. There was something I wanted to say about that. Oh. I think they'll address this, and I know it's addressed in your chapter. Okay. What if we sold these convertible bonds, all right, on April 1st, April Fool's Day, which, by the way, is just right around the corner. Yeah, I think Trump's going to come out on April 1st and say, yeah, this has all just been a joke. I'm kidding. He'd be stupid enough to do that, but whatever. So if we sold convertible bonds, all right, on April 1st, we would not treat those as if they were converted on January 1st because they didn't exist, right? And so if you had some, a convertible or an option that was sold, in the current period, you would have to prorate that, um, just like we did the weighted average number of shares earlier in the chapter. So just know that you'd have to prorate that. So, if we had convertible shares, let's just say it was 5 shares, but we didn't sell that convertible debt until April 1st, you just take that 5 times, 9 divided by 12. Just note disclosure for Clorox Company, all right, 9 million note payable, all right, was converted into 1.2 million shares, all right, on August 1st, earnings per share, all right, or earnings per common share and weighted average shares outstanding reflect this conversion as if it were for all periods presented. Right. So again, we stick with our assumption. The exercising doesn't have an impact, but the initial sale will. Financial presentation on earnings per share, it's at the bottom of the income statement. All right. So basic and diluted earnings per share must be reported, all right, separately from income from continuous operations, net income when income statement includes discontinued operations. Per share amounts for discontinued operations would be disclosed either on the face of the income statement or in the notes of the financial statement. For all reporting periods presented in the comparative statements, businesses without potential common shares present only earnings per share. And so here, right, is an example. Right. What I did want to highlight, okay, is that for every line item after income tax expense, right, you're supposed to calculate the earnings per share. Right? So to get income or net income from continuing operations, okay, you would have had income tax expense up there, right? And then, that would give you the income from continuous operations. And then we have the loss on discontinued. What they're trying to show you here is, as far as disclosure, right, we need to show from continuous operations, okay, this, from discontinued operations, right, giving us the consolidated amount. Okay. And then we do the same thing, right, for the diluted earnings per share. And so what I've told, and I think I told you guys, when it comes to book reporting, the line, right, is income tax expense. And so one way to communicate what we just discussed is that you need to calculate earnings per share for everything below the line, right? The line. Because if we did not have discontinued operations, okay, we would have only had net income of 500,900,000 or whatever this is. Does that make sense? We would have only had this number. Disclosure notes should provide additional disclosure, right? Reconciliation of the numerator and denominator, right? So similar to the calculations that we've been doing. Right? Any adjustments to the numerator for preferred dividends, any potential common shareholders that were shares that were not included because they were anti-dilutive, any transactions that occurred after the end of the most recent period, so after the year end, all right, that would materially impact your earnings per share. And so here is a reconciliation of basic earnings per share, all right, to diluted. The difference between IFRS and US GAAP, right? Deferred tax asset is created for the cumulative amount of the fair value of the options the company has recorded for compensation expense. Right? The deferred tax asset is the tax rate times the amount of compensation, right? Basically what we're saying is we recorded that compensation expense, right, from the first part of this textbook. That was a book expense. We would not be allowed to take that for tax purposes, right? Therefore, that creates a deferred tax asset. For IFRS, the deferred tax asset isn't created until the award is in the money, okay, which means the market value is higher than the exercisable price. Plans with graded vesting, right? Remember, you get so much after 5 years, more after 10 years, and so on. Permits companies to account for each vesting amount separately, but also allows companies the option to account for the entire award on a straight line basis over the entire vesting period. Either way, the company must recognize at least the amount of the award that has vested by that date. Whereas under international, it's just straight line. All right, no, it's not straight line. Straight line is not permitted. There is no requirement for the company must recognize at least the amount of the award that has vested by each reporting date. And that's the end of chapter 19. And so, if you guys don't have any questions, I will pop this up so that you're not looking at the screen when I unshare. I'm going to stop